Hi, I'm Steve Bailey, and today we're going to have a special episode of Financial Freedom Radio. We've been getting a lot of questions from people responding to issues with the economy, issues with COVID-19, and how it's affecting the financial markets. So I'm hijacking the episode today, and we're going to take Ray and we're going to treat him like a puppet, and we're going to have him answer some questions and try to assuage some fears of what's going on in the market. So stay tuned. From Philadelphia, the home of the Liberty Bell, Financial Freedom Radio starts now. Here's your host, Raymond Jewell. Well, it's not really Ray, it's me. Again, my name's Steve Bailey. I'm the guy behind the scenes. And I thought we would hijack today's episode and talk about some things that are happening in the world today, in the economy today. So I think what I'm going to do is I'm just going to kind of freewheel this. This is unscripted. We had a planned show today. Um, but I think today we're going to go off script and we're just going to have a dialogue. So with that, I'm going to bring Ray in. Hey, Ray.
What do you mean hijacking my show?
Well, we've been getting a lot of questions. We've been getting a lot of people who are concerned about, the stock market took a big tumble last week. And I just thought this could be a good platform for us to address some questions. I mean, you've got countless years of experience in economics, in the finance world. And I just thought it would be a
Are
good
you saying I'm
opportunity.
old?
No, what I'm saying is you're smart, you're seasoned, you're wise. Okay, smarty pants. But I just thought it would be a good opportunity for you to kind of address some of the things that are going on and give us your spin on what's going on and see if we can help people feel a little bit more calm about, you know, some of the things. Like for example, the stock market. Talk to me. Um, should I be concerned?
It's too late. What's interesting is when you look at the stock market, we had a crash back in 2008. How soon we forget. And it devastated people financially and they lost huge amounts of money. And then all of a sudden they had to work real hard just to get back to ground zero to start building again. And every time the market drops and people lose money, they lose value. And the favorite saying that people say, well, I got my money back. Yeah, but you should have more because when you work real hard to get back to zero, you've recovered what you've lost and you've lost ground in total. And people just don't seem to get that. The financial people, we're just getting back to the things that we did wrong before. I mean, how many times do people have to have a kick in the head? It's like that old mule. And no disparaging remarks to mules, but you have to slam that mule with the two by four aside its head before he before you get its attention. So when you look at the markets are not and should not be the sole place you have your money. But what do? They put it all in the market, 401ks, IRAs. And when it goes down, people panic and they either sell. I know people that have sold, and I said, don't sell.
Yeah.
Keep your money, keep your money there. It's going to come back. If you sell, you've admitted defeat. First of all, you shouldn't have your money there, all of it.
Well,
I have
that's
a
just it.
small.
I mean, I think one of the things that you've told me over the years is that, it's okay to have some money in the stock market, but if that's your only place where you've got money, you're putting yourself it's like all your eggs in one basket, right? You should never do
Yeah.
that. And if you spend, every and this is what gets me is like it kind of dovetails into what you said
Well, you
is
should never do it in a financial setting. Andrew Carnegie said in business, put all your eggs in one basket and watch the basket. But when it comes to finance, um, you know, you've got it all in one area that when it drops, it drops fast, as we saw.
right, right.
So
And
people
the only
lose
time you really
everything.
lose money in the stock market is when you sell.
No, I've heard that before.
You don't think so?
Uh, tell that tell that to your banker. If you've got stocks and you've got $10,000 worth of stocks and now it's worth 5,000 and you put that on your balance sheet, Is that real loss? Of
Yeah, I
course
guess
it
you're right.
is. And
So
you got to earn more to get back to the 10. And when in reality you should have stayed at the 10 and gone up even higher.
yeah, and you've
You
lost
know,
time. And that's the
that's
one
right.
thing that people don't get is, yes, you're back to ground zero, but all that time, time is
That's
the
right.
one commodity that we have a finite amount of that, and you
Right.
never get that back. And that's one of the
That's
things that's important is, and that's one of the reasons that we do this show is we try to help people understand, uh, you know, how
right.
to maximize their finances and maximize their financial freedom so that they can really leverage the time. Because really, at the end of the day, time is what we all have
Right.
and what we're all running out
Can,
of every single day.
yeah. Can you put the crawler to subscribe, like, and share?
Oh,
Um,
yes. Let's get the
and
shameless plug in.
tell people who I am. Um, one of the things that is important, and financial planners, they hate me for saying it, and they will defend their actions, uh, 100%. But first of all, let me paint a picture here. People give money to other people who they don't really know well. They put their whole financial life's trust in these people's hands, and these people are managing their money, and they're called financial planners. And they put money where they make money because they're in business to make money for themselves. And so, all the way down the chain, you've got people making money off of your money. So, we give money to people we don't know. We get them to invest our money in places we don't fully understand, and we bank our whole life's financial future based on these people, assuming, and I'm getting my plug in for next week's show, financial, political, and life assumptions. So we assume they know what they're doing, when in fact we have no way to verify whether what they're doing is right or wrong. So we put our life savings into the market and we gamble. It's pure gambling.
That's what it
And
is.
all of a sudden, overnight, it seems the market tanks and the feds start doing all sorts of crazy stuff. Had the Federal Reserve, and you know that I'm a fiscal conservative, so I don't answer to any one party. In this case, it's the Republicans because they're more fiscally conservative um, than the Democrats, who are loony as far as what they're talking about. But when the where'd you go?
You wanted your crawl. I had to put your crawl up.
Oh, so you have to only have one screen for that? Oh,
Yes.
nice. So what happens is uh, we can't verify whether what they're doing is right or wrong. And all of a sudden, overnight, boom, everything collapses. And what occurs is financial devastation. Now, if you're a retiree and you're living on that, all of a sudden your lifestyle has dropped. If you're young and you've got uh, all your eggs in that stock market basket, you are going to end up in financial trouble, as we outlined earlier. I only have a small percentage of money in the market. I have it in whole life insurance and annuities, because and financial people laugh at what I tell them. But you know what? When the markets go down, I haven't lost a dime. My money is still where it was the day before the markets went down, and I haven't lost a dime. Indexed annuities, you you can uh, you could get them where they're indexed on funds, but the downside is protected. You always want to protect your downside, but the financial people don't do that. They go, "Oh, index annuities are very expensive." Well, so are mutual funds, so are stocks, because you got to pay money to get them. And when you lose money, what's the lost opportunity cost of losing it? And the lost opportunity cost is when you lose money, What could you have used those dollars for somewhere else? And at what rate of return could you have gotten it from it? So you've got a lost opportunity to spend those dollars that have evaporated.
Right.
And people just don't get it. And the financial people, every actually they're getting bolder. When we started pulling out of what happened in 2008, they were a little timid and they were kind of still touting annuities and whole life insurance and all that. And you let me clarify something. When you put your money in these places, you've got to do it right. You got to know what you're doing. And there's a group of practitioners called LEAP practitioners. And you could Google it, Lifetime Economic Acceleration Process. They build economic models to verify whether what they're doing is right or wrong. They'll actually show a client where they can lose money and how they can correct against it out into the future. So if you're looking for a place to go, Google it. If you want help in finding these people, just let me know and I can point you in the right direction. But
That was how you and I
when
met.
that's right, because I build the economic models, and I show people whether what they're doing is right or wrong, and where they're going to lose if they continue the course. And again, that's I'm drifting over into next week's show, but
Well, for the record,
so,
next week's show was supposed to be this week's show until I took control.
yeah, right. So when you have an annuity, don't listen to the people saying it's very expensive because there's hidden fees in mutual funds, there's hidden fees and all sorts of stuff. The bottom line is you're not going to lose any money when the market goes down because wherever it is, that becomes your new baseline and it just builds from there. Same with a good dividend driven whole life insurance. Policy. And there's several companies out there that I know of: Guardian, Northwestern Mutual, Mass Mutual. There's some good companies that are mutual companies that have dividend-driven life insurance. Now, a lot of people will say, "What's the difference between a mutual company and a stock company?" Well, a mutual company pays dividends to the policyholders because it's owned by the policyholders. The stock companies pay dividends to stockholders because the stockholders own it. So if you have insurance with a mutual company, then you get dividends, which you because you're part of the people that own the company, and they go right in to build your cash value even more.
Hang on,
So,
I want to stop you for a second because I want to ask you a couple of questions. Um,
okay.
One of the things you always talk to me about is that dividend insurance policy thing. Why do you think that the financial planners or the people, I drive down the road and I see advertisements on billboards for financial planners all over the place. Why do you think they're not telling people to do this?
It's a great question. They're not doing it because they don't have a good understanding of macroeconomics. They don't understand where the inefficiencies are and how to fix them, and they don't understand how to explain it to people so that they understand it. So they go to where they can make the most money and the easiest money. Excuse me, the easiest money, and that's in the stock market. Everybody knows the stock market. People feel that there's an allure of the stock market. Oh, I'm invested in the stock market. You go to parties, I got my stocks. I got my Microsoft stocks or my Apple stocks. They may have 10 cents in the market, but they're talking like J. Paul Getty. So they uh, the allure is there, and it's easier for a financial person to sell that because remember they're in business to make money and they get paid commissions. And if they sell your stock, if they call you up and sell your stock, say, I think we ought to sell and buy X, they get another commission. They get a sell commission and a buy commission. So uh, the government has laws against it. It's called churning, but and the same in insurance. If you talk to somebody and they're selling insurance. They want to replace what you currently have with what they have because they want to get a new commission. I would never, ever, ever in my wildest dreams replace a whole life policy. I don't care what company it's with, because any policy is good if it's seasoned. It will build, it will beat markets because of the fact that markets go down and severely impact your growth. And so,
So what is
uh,
it again that you call it? You call it a dividend whole
dividend
life?
driven whole life insurance policy. Now, you
So
want to get it from the right company, but you
so
never want to let your financial guy come in and replace it. The only time you should fool around with life insurance is if you're trying to get a lower term cost.
so hang on a second. Do me a favor and in 5 seconds or less, at your best 3rd grade level, because I'm ignorant in some of this stuff. Tell us what a dividend driven whole life policy. What's the purpose? Does it pass your youth growth test? Does it, what's the benefit, not just from a financial, but I hear insurance, so I'm assuming there's some kind of a death benefit involved. So kind of bring us up to speed on what that is,
Okay. You've got three components in a whole life policy. You got guaranteed cash value,
which
you've
is
got dividend, which is guaranteed, contractual. Most policies have a 4% guaranteed cash value growth,
okay,
which is far better than you can get in any savings account. You've got dividends, which are paid by the company based on the efficiency of the company. If the company runs a really efficient operation and they have money left over at the end of the year, then they end up paying that back to the policyholders because they own the company. And that's mutual companies. And then you've got death benefit. Death benefit is when you take out $1 million policy, the company has the risk up front. They take 100% of the risk, but they know that at whatever age you're doing it, they have an actuarial table that tells them what's the percent of you dying. So
right.
they take the risk up front. But over time, as you get closer to dying, their risk diminishes and your cash value and dividend values start to grow. So your death benefit becomes your cash value, your total cumulative cash value. No, not cumulative, but your total cash value with the dividends and guaranteed cash value and whatever risks they're willing to share, totaling the full amount of the death benefit.
So
That
basically,
being
so let me just play this back to make sure I understand it. So what you're saying is that at the beginning, you take out $1 million policy and they assume
right,
all the risk. And
right,
then over time, you're paying premiums, but those premiums are actually going into the cash value. So the amount of money that they're committing to pay you on your death, the amount that they're going to take out of their pocket is getting less and less because you're putting more premium into it.
right.
Is that right?
Yeah.
Okay.
Well, what happens the first year, you probably have very little cash value
Right.
because they take out their charges and everything. It's all front loaded. And then the second year, you probably have maybe 50 or 60% of what you've paid in over the 2 years. At the end of 5 years, your break even point should be at the end of 5 years, you should have what you've paid in, maybe 80 or 90%. At the end of 10 years, you should be whole and then some.
Gotcha.
And the best way to look at that is, you know, people that invest, wealthy people will look at the growth on an annual basis. What am I getting in X account on an annual basis? And do I want to continue doing this or do I want to look at something else over here? So if you look at your growth on a yearly annual basis, when you get to about I think it could be, depending on the insurance company, it could be around 8, um, 7 year, the amount of money you've put in has to be greater. Your cash value will exceed what you've put in. You're
Right.
starting to get growth.
Now you're starting
So
to get growth.
you get through those rough years, and then that thing's taken off. So you asked me about use and growth simultaneously. So if you've got cash value, when you create a loan from an insurance company with and it uses your cash value as collateral, you borrow that money out. If you take that money and you go over and you buy a piece of real estate, they don't take the money out of your insurance policy. They create a loan from the general fund of the insurance policy or the insurance company with your
Right.
policy as
Right.
collateral. So when you take your money out and you go and you buy a say a rental property, you you end up having that rental property grow faster than what they're charging you in interest. So you're using the money while it's still growing over here in the insurance policy. And it's hard for people to conceptualize that. The financial people just don't get this.
Right.
But what occurs is when you see it on paper, it light bulbs start going off. So you end up in the insurance policy, you end up getting use and growth simultaneously. You can't do it in annuities because they have what they call first in, first out. So the money that you put in, I think it's first in for it used to be first in, last out. So the money coming out, if you were to take it, they're going to charge you taxes on it. But again, I've been away from it for a long time. I haven't built the models. You need somebody that's current with it. I built my business and sold it, so I haven't actually worked the models. But when I did do it, we could show all of that, and it was phenomenal. But back to our original topic, I'm not here to sell life insurance
Right. Right.
or annuities, but my point is that people need to know that there are places that they can put their money. And whenever the markets go down, they could still benefit from the market growth, but whenever they go down, it doesn't go below a bottom line point.
So I think the mess, and then I'm glad you did that because I was about to bring it home, and you're right, we were going way down into the water, but I think it was important because one of the things that attracted me to you as an economic coach was that idea of diversification, and not only diversification, but into areas that regular financial planners aren't telling you. They're telling you to get into mutual funds. They're telling you to get into the stocks. They're telling you to get into all the stuff that they know how to sell that maximizes their commissions, that makes the most money
Yep.
for the company and not necessarily the best idea for you in a long-term position. So, and that's what I wanted you to kind of touch on was, the people who are panicking, who are knee-jerk reacting to, sell, sell, sell because, the market's tanking. If you're divested properly, if you've got your money into all the right vehicles, you're not losing your shirt when the market does this, and you can ride this out because we all know that at some point the market's going to bounce back.
Yeah, one of the things that the financial people don't understand. When you put your money into a whole life policy, you're purchasing the death benefit up front. You're not paying the commissions. The commissions are paid out of they're front loaded out of the coffers of the insurance company. Because if they were paying the commissions up front, then for the first 5 years or 4 years, you would or maybe 3 years, you would end up not getting any cash value. But a good dividend driven whole life policy from a mutual company will give you cash value in the first year. So, and in the second year, it'll just start to take off. Um, but make no mistake, the insurance guys make a lot of money. They get commissions, and they get renewals every year. So they have a vested interest in keeping you going,
Right.
unless you're churning from one company to another, and you want to look out for that because that makes no sense. And there's laws against it, but they can't police it. It's just they try to have forms to fill out, replacement forms, and all that kind of stuff. But
So,
the only thing that
go
you
ahead.
should be replacing on an annual, not annual, but every so often, take a look at your term insurance because the rates do change on that. They go down because mortality keeps getting longer and longer. I mean, I'm 75 years old, and my mortality, who knows? They're telling me it's 86, but I'm planning on going to 100.
75 years young, thank you.
There you go. Yeah.
All right, so we're getting close to
How
time.
long have we been going?
We're at 25 minutes right now. What would you want to say to just kind of wrap this up and tell people, you know, this is your
Well, use
platform. Don't get political, but just get financial and tell them, give them a nickel's worth of free advice to ride this storm out.
use this as a teachable moment. I thought 2008 would have been a teachable moment, but I guess not, because people forget. They think they're financially immortal. They think they're indestructible financially. And of course, all the people are out there hawking all these programs and all of these products that the allure of them. But don't be lured into that kind of stuff. Get something that protects your bottom line, even though it may not be the 10 or 20% growth. If you systematically get 6 to 8% and you suffer, and whenever the markets go down, you don't lose anything, you're really beating the markets. I'm beating the markets with with the places I have my money. My insurance policy beats the markets because these downturns are severe. And it's got nothing to do with the overall economy. The stock markets are only a small piece of the economy. The economy is still moving and shaking, even though we've got this coronavirus and the markets have gone down. And we're talking about, this is the 16th of March in 2020. So we'll be able to look at this and kind of see the difference a year from now and see where the markets are. But the point I'm making is protect your bottom line. You work hard for this money. Get use and growth simultaneously in everything you do, and go back and listen to other shows that we've done. It'll give you a good grounding into what to expect. So I want to thank you all for coming and tuning into financialfreedomradio.com. Have a great week, and we'll be back here next week. Take care. God bless.
Thanks for listening. Please remember to subscribe to the podcast. If you want to learn how to create real sustainable wealth like the extremely rich people do, or maybe you just want to sustain the wealth you already have, you need to check out Dr. Ray's new book, Why the Rich Are Rich. Ray's been coaching clients for 35 years and has completely unlocked the secret strategies that rich people use day in and day out to grow and sustain their wealth regardless of what's going on in the economy. His book is completely free, and you can get it by going to whythericharerich.com and entering your email address. Again, that's whythericharerich.com. Head over there now.